Have you ever wondered why your take-home pay is so much lower than your salary? In this video we explain exactly why, simply and clearly. If you have ever been surprised by how much less you receive compared to your salary, you are not alone. There are clear and completely legitimate reasons why your take-home pay is always lower than your gross salary. And once you understand them, your payslip will never feel confusing again. The salary in your contract is your gross pay. It is the total amount your employer agrees to pay you before anything is removed. Think of it as the top of a staircase. Every deduction takes you one step down towards your actual take-home pay. There are three main steps. The first and usually largest deduction is income tax. This goes directly to the government via HMRC. In both the 2025 to 2026 and 2026 to 2027 tax years, you pay no tax on the first £12,570 you earn. Above that, most people pay 20% on the next portion of their earnings. On a salary of £25,000 a year, this works out at around £191 a month. The second deduction is national insurance. This is completely separate from income tax. It goes towards funding the NHS, your state pension, and certain benefits. In the current and upcoming tax year, you pay 8% on earnings above £12,570 a year. On a salary of £25,000 a year, this is around £84 a month. The third deduction is your pension contribution. If your employer runs a workplace pension scheme, a percentage of your pay goes in automatically every month. The minimum employee contribution is currently 5% of qualifying earnings. On a salary of £25,000 a year, this is around £104 a month. This money is not lost. It is yours, being saved for your future. After all three deductions have been taken out, your gross pay becomes your net pay. This is the amount that actually reaches your bank account on payday. It will always be lower than your salary, and now you know exactly why. Here is a real example. Someone earning £25,000 a year has a monthly gross pay of £2,083. After income tax of £191, national insurance of £84, and a pension contribution of £104, their net pay is £1,704. That is a difference of £379 every single month between their salary and what they actually receive. Understanding why your take-home pay is lower than your salary really matters. It helps you plan your budget using your real income. It helps you avoid being caught short after payday. It helps you compare job offers with confidence. And it helps you understand your payslip without confusion. This knowledge is useful in so many situations. When you are starting a new job and want to know what you will actually take home. When you are budgeting and need your real income figure. When you are comparing two job offers and want to know which one actually pays more. And any time you feel confused looking at your payslip. The most common mistake people make is accepting a job or making a financial commitment based on the salary figure alone, without calculating their take-home pay first. A salary of £30,000 sounds very different to a take-home pay of around £1,950 a month. Always use a free online take-home pay calculator before making any major financial decisions based on a salary figure. To recap, your salary is your gross pay. Income tax, national insurance, and your pension contribution are all deducted automatically every month. What remains after those three deductions is your net pay. That is your real take-home pay, and the only number that matters when managing your money. Thank you for watching. If this helped, please subscribe for more everyday topics explained simply.